Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It's good to be back. And, looking at the sheer amount of data we have this morning, it's a strange one.
It is. Usually there's a clear narrative, right? The market's up or it's down.
Right. It's either a boom or a bust.
Yeah.
But today, we're looking at a market that just seems completely at war with itself.
That's the perfect way to put it. It feels like we're looking at two different worlds. On one hand, you've got the S&P 500 hitting these record highs, tech bookings going just nuclear.
And you flip the page.
Exactly. And you see these massive, massive crashes in healthcare stocks and just what you can only call a frenzied panic over gold prices in China.
It's a world of contradictions today.
Right.
We're seeing extreme optimism and extreme panic happening at the same time. And often they're driven by the same geopolitical triggers.
So we've got a lot to unpack. We're going to dive into let's call it the engine room of the AI boom with ASML's earnings.
Those were shocking.
Absolutely. Then we'll try to figure out why Alphabet is suddenly surging while Microsoft and Meta are under pressure. We also have a huge geopolitical shuffle happening.
The EU, India, the UK, China, they're all trying to make new friends before these tariff clouds roll in from the U.S.
And finally, we have to look at those panic trades.
Yeah.
The gold rush in Shenzhen and the absolute bloodbath in U.S. health insurers.
It's a complex web. I think the best place to start is upstream with the machines that actually make all of this possible.
I agree. Let's do it. ASML, the Dutch giant. For anyone who needs a quick refresher, these are the people who make the super advanced machines that print the world's most powerful computer chips.
The only ones who can, really.
And we got their Q4 2025 earnings report from CNBC and the headline number for bookings. I mean, I honestly thought it was a typo.
You and probably half of Wall Street. It was a staggering number.
So analysts were modeling somewhere around 6.3 billion euros.
Which would have been a perfectly good, healthy number.
But ASML came out and posted 13.2 billion.
They didn't just beat the estimate. They more than doubled it. It's a massive beat.
But we need to look past that headline number, right, to understand why.
Exactly. That 13.2 billion tells us that the demand for AI infrastructure isn't just continuing. It's hitting a new, more intense phase of acceleration.
So what's different now?
Well, the interesting thing I saw in the CNBC report is that the profile of the demand has shifted. It's not just about the logic chips anymore, the brains.
Ah, the report flagged a memory shortage.
Exactly. For the last 2 years, all the oxygen in the room was GPUs, right? NVIDIA's logic chips.
Sure.
But you can't run a GPU without high bandwidth memory, HBM. And we're now seeing a really severe crunch in memory semiconductors. Analysts think this shortage is going to last well into 2027.
So this is like the entire supply chain realizing they forgot to buy the RAM to go with their shiny new processors.
That is a perfect analogy.
Yeah.
It's the forgotten bottleneck. So now you've got the big players, Samsung, SK Hynix, scrambling to buy ASML's machines, specifically their EUV machines,
Just to make more memory chips.
just to increase their memory fabrication capacity. It's a catch-up trade. They're running red hot to fix a problem that could stall a whole AI rollout.
Okay, that makes sense. And it lines up with TSMC posting record profits. The factories are full, but here's the contradiction I can't get past.
The layoffs.
Yes! Record-breaking orders, the stock should be a party, and yet, in the same announcement, they're laying off almost 1,700 people.
It feels completely counterintuitive. You double your orders, so you fire people.
Their reasoning was corporate speak. They said the company had become less agile.
Less agile, yeah. We have to translate that. Most of the cuts are in the Netherlands and the U.S. This isn't just about cost-cutting. This is restructuring for a new geopolitical reality.
You mean China?
Look at their guidance for China. It tells the whole story.
I saw that. They expect revenue from China to drop to 20% of total sales this year. It was 33% last year.
That's a huge decoupling. It's the key. Because of the tightening export restrictions from the U.S. and the Netherlands, ASML simply can't ship its most advanced machines to China anymore.
So that 33% of revenue, that door is just closed now.
It's being walled off. So even as they're booming everywhere else, they have to re-architect the company to survive in a world where their second biggest market is, for their best stuff, effectively gone.
So the boom is real, but the world they can sell to is shrinking.
Exactly. They're trimming the teams that supported that China business because that business is now, well, essentially illegal.
Wow. Okay, so that's the machinery. But what about the companies actually buying it? This brings us to big tech earnings. We've got a Reuters report that calls this the show me phase of AI.
And the stakes could not be higher. We had Microsoft and Meta reporting today, and the market reaction has been, well, let's call it divergent.
Divergent is a gentle way of putting it. On one side, you have Alphabet, Google just surging.
The stock is up 29% in the last 3 months of 2025. For a company that size, that moves the whole market.
So it's finally going right for them. For a while there, they were seen as the ones who were behind.
It seems like the market has finally decided that Google isn't the AI loser anymore. The narrative shifted. The Gemini 3 model was well received, but the real kicker was that deal to power Apple Siri.
That's a huge get, capturing the entire iPhone ecosystem.
It's the ultimate distribution channel. Analysts are pointing out that Alphabet has these proprietary ecosystems, Search, YouTube, and now a deeper hook into Apple. It's a defensible moat.
And investors love a moat.
Especially when the tech is changing this fast. It buys you safety.
So Google's the winner for now. But then you look at Microsoft and Meta. Both stocks are down more than 6% over the same period. Microsoft was supposed to be the leader here. What happened?
Well, struggling is relative. They're still printing cash. But they are facing what Morgan Stanley called a wall of worry. The problem for Microsoft right now isn't demand for AI.
What is it then?
It's physics. They've admitted they're facing AI capacity constraints that will probably last until June.
In this market, 6 months is forever. What does capacity constraints actually mean? They can't get the chips.
It's more than that. It's the data centers to put them in. It's the power cooling. It's the connections to the energy grid. They literally cannot bring servers online fast enough to meet the demand for their Azure OpenAI services.
So they have the orders, they just don't have the plugs.
Basically. It's a wild problem to have. We have too many customers, but Wall Street hates it because you can't book the revenue. You're leaving money on the table.
And on top of that, you have the memory chip prices we just talked about.
Right, the shortage. Those high prices are hurting the PC market. It makes laptops more expensive, which hurts margins for Windows and for their Xbox division. It's all connected.
So amid all this supply chain chaos, there's a bigger question, maybe a bubble in the room. You found some data from a PwC survey that was, frankly, a little alarming.
This is the stat that keeps me up at night. PwC surveyed over 4,000 CEOs. These are the people writing the checks. And more than half of them said they have realized neither revenue nor cost benefits from AI yet.
Nothing. Zero.
Essentially, yes. No tangible impact on the bottom line. No, we cut costs by X. No, sales went up by Y. Nothing they can point to on a balance sheet and say AI did that.
But at the same time, companies are projected to spend over $500 billion on AI this year.
And that is the terrifying disconnect. $500 billion in spending, and the customers, the CEOs, are saying, hey, we haven't actually made any money from this yet.
That feels like a clock is ticking.
That is the tension that's going to define this year. It's the show me phase.
Oh.
Investors are done with, we're buying chips. They want to see we're selling products that people are paying for.
Speaking of things that are very real and not theoretical at all, tariffs, the geopolitical board is moving fast. We've got reports from CNBC about the UK, the EU, India. Everyone is scrambling.
It's the Trump factor. Let's just call it what it is. With the new administration signaling these big universal tariffs, everyone is trying to build a shelter before the storm hits.
Let's start with the UK. Prime Minister Keir Starmer is in China for a 3-day trip. That's a big deal, right? First time a UK PM has gone since 2018.
And he didn't go alone. He brought nearly 60 business leaders, the heavy hitters, HSBC, Airbus, AstraZeneca.
That's not just a diplomatic visit, that's a sales mission.
It's a clear signal. The UK is in a tough spot post-Brexit. They're trying to balance trade with security. They see the U.S. pivoting to protectionism, and they know they can't afford to be locked out of China, too.
So they're hedging their bets.
They have to. Bringing all those CEOs sends a clear message to Beijing. We want to do business no matter what Washington says.
And while that's happening, the EU and India just announced what they're calling the mother of all deals.
This is huge, and it came together faster than anyone expected. A free trade deal covering 90% of goods. India is lowering tariffs on European cars and agriculture.
Which are historically super protected sectors in India.
Incredibly protected. And in return, the EU is lowering tariffs on Indian textiles and leather.
But the timing isn't an accident.
Oh, not at all. This is purely defensive. They're trying to lock in trade volume before U.S. tariffs can hit. If the U.S. puts a 20% tariff on European cars, they need somewhere else to send them.
So they're creating their own block to absorb the shock.
Exactly. But that has risks. U.S. Treasury Secretary Scott Bessent has already criticized the EU for making this deal.
It feels like poking the bear.
It is risky. By signing this deal, they're basically signaling that they're diversifying away from the U.S. That could easily accelerate the trade war instead of preventing it.
It's like watching kids try to build a fort while the adults are arguing.
That's not a bad analogy. And some kids are smarter than others. Look at what South Korea's SK Hynix is doing. A completely different strategy.
This was clever. Instead of trying to get away, they're buying their way in. They're setting up a special AI company based right here in the U.S.
It's corporate diplomacy at its finest. The Trump administration has been very clear. Invest in America if you want to avoid tariffs.
So this is tariff jumping.
In its purest form. They're restructuring their subsidiary and committing at least $10 billion. They're building an advanced chip packaging plant in Indiana.
So if they build the plant in Indiana, they become a domestic producer.
And they get to keep their supply lines open to their most important customer. It's a $10 billion insurance policy, but for them, it's just the cost of doing business now.
So everyone is scrambling. But while all this high-level strategy plays out, the markets on the ground are, well, they're panicking. We have to talk about these market extremes.
This is where things get really wild.
Let's start in the U.S. The S&P 500 hits a record high, but if you were holding healthcare stocks on Tuesday, you got wiped out.
It was a bloodbath. United Health down 20%, Humana down 21%.
In a single day. These are supposed to be stable, blue-chip companies. What on earth happened?
Regulatory risk. A single proposal from the government. The Centers for Medicare and Medicaid Services proposed keeping the rates for Medicare Advantage nearly flat for 2027.
And flat is bad news.
Flat is a disaster when your costs are rising. Medical inflation is 5, 6, 7% a year. If the government pays you the same amount as last year, that inflation just eats your entire profit margin.
So the market just instantly repriced the entire sector.
Instantly. It's a brutal reminder that a single pen stroke in Washington can wipe out billions in value overnight.
But if you think that's chaotic, let's go to Shenzhen, China. A Bloomberg report on a precious metals frenzy. That sounds like something from another century.
It's a classic panic. Gold prices in China are over $5,300 an ounce. Silver is up 60% in 4 weeks.
60% in a month? That's not a commodity, that's a meme stock.
It is. And the scary part is the premium. Silver is trading at a 36% premium in China over the global price in London.
Wait, why would anyone pay 36% more for something than it's actually worth?
Because they can't get their money out of the country. This is capital flight. The property market is a mess. The stock market is volatile. People are desperate to hold anything tangible. They don't care about the premium. They just want out of the yuan.
And it's getting ugly. The report mentioned protests.
Yes. This is where it spills into the real world. Trading platforms are halting withdrawals, so people are crowding their offices, demanding their gold. The police are getting involved.
A run on the gold vault.
Exactly. It shows the level of desperation. It's a polar opposite of the AI optimism we see in U.S. tech. It is pure, simple fear.
So let's try to tie this all together. On one hand, you've got ASML and the chip makers betting the farm on AI infrastructure.
Right. But at the same time, you have their biggest customers, like Microsoft, literally hitting physical walls. Not enough power, not enough servers.
And a shareholder base that's starting to get impatient.
And while that tech story plays out, the global trade map is being redrawn in real time to avoid tariffs.
And on the ground, investors are either panic selling healthcare because of a government proposal or panic buying gold because they don't trust their own government.
It all comes down to the timeline,
What do you mean?
Well, here's the thought I want to leave you with. We know companies are spending over $500 billion on AI this year. We know capacity is constrained. But we also know half the CEOs see no benefit yet.
Right?
So ASML and the others are building factories today for demand they expect tomorrow through 2027. But what happens if that capacity constraint turns into overcapacity in 2027? If the customers, the CEOs, don't start seeing a real return on investment soon, they're going to stop spending. And if they stop spending just as all these new factories come online, who's going to be left holding the bag?
That is a very, very expensive question, and I think we'll be watching for the answer for the next 18 months. On that note, we'll wrap it up. We'll see you all tomorrow morning with new headlines from major financial magazines.